Hi everyone, welcome back to my channel. Today we are learning a very important topic. We are talking about the summary of IFRS. What is IFRS? International Financial Reporting Standards. For every accountant, every chartered accountant, every new accountant, and at higher levels also, IFRS is something which is a very important principle to be understood. These are accounting policies and standards to be followed. Let's learn and understand few important aspects in summarized form for all the IFRSs. Now, before we start and before we look into it, the one point that I would like to make clear here is that there are some changes and recent updates that have been added as addendum to the current IFRS, which we will discuss in the upcoming videos and in the next series. So let's get started with the summary. IFRS 1 talks about the first time adoption. Now, it was first time transition made between the years 2003 and 2004. Earlier, there was GAAP, which is Generally Accepted Accounting Principles, and then the IFRS was introduced by the Accounting Standards Board. That's the history. But in summarized form, in the first time adoption case, it speaks that there should be no retrospective application of this standard. The reporting entity has to prepare a complete set of financial statements for current year and previous year. That is the requirement under IFRS 1. IFRS 2 talks about share-based payment transactions. So entity is supposed to recognize any share-based payment transaction in its P&L. So any transaction and the resultant profit or loss out of that transaction has to be recognized in the P&L of that entity. Third, business combinations. This speaks about the cost of acquisition, which should be measured at fair value, and excess of assets versus liabilities is considered as goodwill. So you need to recognize and measure the fair value, and the excess of assets versus liabilities is goodwill that will be recognized in the financial statements of the entity. Coming to next point, insurance contracts, IFRS 4. This means that the insurer accepts the insurance risk to compensate the policyholder in time of any emergency. So, there also needs to be done an impairment test, or this is in the time of any contingency. So, in terms of that contingency, the entity and the insurer is supposed to do an impairment test for the thing insured. Next, non-current assets or discontinued operations. Here it speaks about the non-current assets in a company or the discontinued operations. They should be measured at lower of carrying amount and fair value, less costs related to selling that item. Next point here it says is there is no depreciation to be charged on such assets. The other disclosure requirement is that there is a separate presentation required in the balance sheet and P&L for such discontinued operations or such non-current assets. They will be measured at lower of carrying amount versus fair value minus the cost of selling that item. IFRS 6, exploration and evaluation of mineral resources. Here the main point it says that the entity has to perform an impairment test. When do we do an impairment test? When the carrying amount of that particular asset is greater than the recoverable amount. Then we do an impairment testing. IFRS 7 speaks about financial instruments disclosure requirements. Next, after this, we will come to the detailed financial instruments. But under IFRS 7, it speaks about the disclosure requirements. Here it is bifurcated into two, qualitative and quantitative. Qualitative disclosure requirements could be management decisions, etc. And quantitative disclosure requirements means The entity has to assess the amount or the quantum of risk that is involved in such insurance contracts or at the time of understanding the financial instruments. Number 8, operating segments. Now, this is applicable to public listed companies. They are supposed to disclose the nature and financial effect of business in different operating segments and geographical areas as well as economic environments. So, this is for any public listed company to disclose the nature and the financial effect of its business, whether it's operating in different geographies, different operating segments, and different economic environments. IFRS 9, this is one of the most important IFRSs. Remember, at any given point of time, when anyone is explaining or trying to explain the IFRSs, or if during an interview you are asked about few important, any critical IFRS to be considered, this is one of the most critical IFRSs, which is financial instruments. This comes in relation to banking mostly. This came into effect with effect from 1st January 2018. This is January 2018 when this IFRS came into effect. This talks about classification, measurement, recognition, and impairment of financial asset or financial liability. Now, what is a financial asset? In terms of the financial instruments, how do you do the treatment, the accounting treatment for these particular items is what it explains, and this is just the crux of it. So for financial assets, the entity has to give an intention. What is the intention of the business? If the intention is to hold that asset, then it will be amortized. For example, bonds. If the intention is to hold and sell, then it will be calculated at fair value through other comprehensive income. It will be recognized under fair value through other comprehensive income. And if it is others, other than hold and sell, if it is an others category, then it will be recognized under fair value through P&L. So this is for financial assets. Coming to shares, if the intention of the entity is to keep, it will be recognized under fair value through other comprehensive income. If the intention is to sell or others, then it will be recognized as fair value through P&L. Now for financial liabilities, which is loans, or if you issue bonds, it is supposed to be amortized. Then there is derivatives, short term. This is going to be recognized under fair value through P&L. Now the last point to consider here is impairment. So here in terms of financial instruments under IFRS 9, expected credit losses have to be provided for 12 months, for 1 year, at the inception itself, from day one itself. This is one very important change that has come into effect for financial instruments. So in terms of banking, this is a very important change. So at the inception of the period itself, the expected credit losses, a provision has to be made. And if after the period of 12 months, there is a significant increase of that particular instrument to be expected to be unrealizable, then that particular item will be provided for its lifetime. So then you are going to make a provision for its entire life. Next comes IFRS 10, which is consolidation. Here the entity is supposed to consolidate all the financial statements of the parent and the subsidiary as a single economic entity. So everything will be consolidated together as a single economic entity. What you need to eliminate? Eliminate the carrying amount of parent's investment in the subsidiary and vice versa, carrying amount of equity, and intercompany transactions. So at the time of consolidation, we have to remove all intercompany transactions, and the entity has to consolidate the financial statements of parent with subsidiaries as line by line, which is called line item consolidation. Then there is joint arrangements. This is the arrangement of two or more parties to have a joint control over an entity. And then they jointly look into the financial statements of that entity. Next comes the disclosures of interest in other entities. Here it says that they have to disclose the information on the nature and the risk involved in associates, joint agreements, subsidiaries, and the effect on the financial position, cash flow, and financial performance of those entities, which means that any entity which has an interest in another entity, they have to disclose the information regarding the nature and the risk of their associates, subsidiaries, joint agreements, and the effect on their financial positions, and submit their financials accordingly. Next comes fair value measurement. This is the price that you have to receive as an entity to sell an asset or transfer a liability. This is to be done at market condition of those goods, for which the fair value measurement or the fair value calculation will be taken into account. Next comes Regulatory Deferral Accounts Board. It is an amount of income or expense that is not recognized but deferred by the Rate Regulation Authority in fixing the price of it, which means that this is a Rate Regulation Authority, Regulatory Deferral Accounts Board. There, this authority is going to decide the amount of income or the expenditure that will not be recognized but it will be deferred, and the amount will be fixed according to the price that is being divided by the decided by the RDAB. Next comes another critical IFRS. This is also, as we spoke about IFRS 9 being one of the most critical IFRSs, this one is also one of the very, very important IFRS, revenue from contracts with customers. Most of the businesses base themselves on this particular IFRS. So remember, IFRS 15 is one of the most critical IFRSs that you need to remember, understand, have in-depth analysis. But since we are talking about the summarized form only, we will talk about the gist of this particular IFRS. This IFRS came into effect from 1st January 2018. There are 5 steps to it. First, you identify the contract. Next, you identify the performance obligation in the contract, specified within the contract. Then you determine the transaction price. Then you allocate the price to its product or the service. And then the last point is recognize revenue. So these are the 5 main steps involved at the time of revenue recognition in relation to contracts with customers. Now here, there is a single model for performance obligation if the performance obligation is over time or point in time. If it is point in time, then percentage of completion method is utilized. Now, there is also something called relative standalone selling price. When you are trying to determine the transaction price and when there are more than one item, then or more than one activity is involved, then you have to calculate the relative standalone selling price. And there is a single model performance obligation identification method if it is over time or point in time. And revenue is recognized when the control is transferred. Next comes IFRS 16. This came into effect from 1st January 2019. This is about leases. Here we are saying that there is a single lease accounting model that has been introduced through this IFRS. This IFRS speaks about recognition, measurement, presentation, and disclosure requirements. The major change that has taken effect on IFRS on leases is that there is no classification of operating and finance lease in the lessee books. Earlier, they were bifurcated into operating and finance lease. Before, the lessee was recognizing right of use of asset as operating lease under P&L. Now, all lease has to be treated as single right of use, lease liability. So, both lessee and lessor will recognize the financial asset. This particular IFRS is also very important in terms of leases, but the major change, as we spoke, is mainly on the classification and how you are going to recognize the right of use of asset. Last but not the least comes the IFRS on insurance contracts. Now here, this has come into effect from 1st January 2023. This mainly speaks about current measurement of future cash flows. Here we use the discounting rate. So the insurers or the insurance companies, how they do the calculation of the future cash flows, what risk is involved, and what is the risk that they are accepting as insurers. Plus there is another term called contractual service margin, which is the earnings that they are making out of any contract through insurance, that has to be recognized in the P&L. So contractual service margin is one new terminology. Hence, these are the summarized gists of IFRS that we spoke. There is a lot of matter on the detail of these IFRSs. To know for more, please subscribe to my channel. Keep watching and thank you.